Welcome to Stress-Free Investing Analysis, Personal Notes. Today, we're looking at a classic opportunity in disguise scenario. We're going to break down a truly world-class business that's currently trading at a massive discount, and well, we're going to see exactly what the market is missing right now. But hey, before we explore today's completely misunderstood market opportunity, just take a quick moment to read and acknowledge the mandatory SEBI disclaimer up on your screen. All right, let's get right into it. Here's the roadmap for today. First, we'll look at the dominant market leader. Second, their exceptional financial health. Third, the temporary cyclical stumble. Fourth, three massive growth catalysts. And finally, the valuation and our final verdict. All right, Section 1, the dominant market leader. So, AC holds a commanding 63% domestic market share in pick-and-carry mobile cranes. I mean, 63%. That is absolutely massive. In fact, they're the #1 global leader and the world's largest producer in this specific category. Plus, they hold over 60% of the domestic market share in fixed tower cranes. So for all intents and purposes, in their core categories, AC operates as a near monopoly in India. But they aren't just a one-trick pony here. They operate across 4 critical infrastructure verticals. Beyond their dominant cranes, they manufacture material handling equipment. Think forklifts, where they hold a 19% domestic share and are actively gunning for 25%. They also do construction and agricultural equipment. And this whole operation? It's supported by a massive distribution moat they've built over decades, with a dealer network of over 125 sales and service locations across India, not to mention exports to over 37 countries. Their end customers are perfectly positioned for India's growth, with heavy exposure to manufacturing, logistics, and infrastructure. For us as investors, this wide economic moat provides a huge layer of safety against any new competitors trying to muscle in. Moving on to Section 2, exceptional financial health. Now check this out, a staggering 40.3% return on capital employed. That is absolutely phenomenal for a heavy manufacturing company competing in the construction equipment market. It places ACE squarely in the top decile of Indian capital goods companies. And their EBITDA margins, they've expanded dramatically, essentially tripling from 9.7% in FY21 to roughly 18.9% in the first 9 months of FY26. What we're looking at here is a story of relentless structural quality improvement driven by a better product mix, serious operational leverage, and real pricing power. And remarkably, they've achieved all this hyper-efficient growth with absolutely zero long-term debt. None. They've been completely debt-free since FY22. Instead of carrying debt, they've built up this massive net cash war chest of 592 crore rupees in cash and investments. Furthermore, they boast a negative cash conversion cycle of minus 37.6 days. Think about that for a second. That means ACE literally collects money from its customers before it even has to pay its suppliers. It's just a phenomenally clean, high-quality business. Which brings us to Section 3, the temporary cyclical stumble. So here's the million-dollar question. If the business is this good, why did the stock correct 35%? It dropped from its all-time high of 1,389 rupees all the way down to the current 906 rupees level. Why did a company that compounded revenue at 28% and profit after tax at 50% over the last 5 years suddenly hit a wall? Well, this drop was caused by a perfect storm of 4 temporary cyclical headwinds that all hit at the exact same time in the first half of FY26. First, we had extended monsoons, which severely delayed project executions. Second, there was a regulatory transition from BS3 to BS5 emission norms, causing major inventory and pricing disruptions. Third, political elections temporarily paused government infrastructure spending. And fourth, severe Chinese dumping of heavy cranes eroded ACE's market share in that specific subsegment. But here is the absolutely crucial takeaway. These are not structural flaws in the business. No way. They are transient, cyclical headwinds. The monsoon's passed, the emission transition is complete, and the elections are over. Let's dive into Section 4, 3 massive growth catalysts. Look at how brilliantly the management team has responded to that 4th headwind, the Chinese dumping. This issue is actively being resolved right now by an upcoming anti-dumping duty of roughly 24.9% to 52%, which was recommended by the Directorate General of Trade Remedies. But AC didn't just sit around waiting for government protection. They went on the offensive. They signed a 50-50 joint venture with Japan's KATO Works. This brings premium Japanese technology to their heavy cranes, and it's perfectly timed to launch just as those Chinese imports become prohibitively expensive. This JV is targeting 300 to 400 crore in revenue within just 2 to 3 years and over 1,000 crore in 5 years. It's a massive structural catalyst. And the catalysts don't stop there. Adding incredible revenue visibility to their material handling segment, ACE just secured their largest ever Ministry of Defense order. We're talking about a 420 crore contract for over 1,100 forklift trucks, which is going to be executed over the next 3 years. This brilliantly diversifies their revenue stream and gives them fantastic countercyclical stability. Finally, Section 5, Valuation and our final verdict. So with structurally higher margins, zero debt, and these massive catalysts on the horizon as we enter FY27, we really have to ask what the market is currently pricing in. Are we overpaying for this future growth? Well, not at all. At a price-to-earnings ratio of 24.8, the stock is trading near a 5-year low. Historically, during normal growth years, ACE commands a PE multiple of 35 to 40. The market is currently pricing in this temporary FY26 slowdown as if it's some permanent feature, completely ignoring the structural quality of the business and the incoming catalysts. This cleanly models our 2 to 3 year horizon. In a base case scenario where the JV ramps up steadily and margins hold at 18%, we're looking at a target of 1,050 rupees or a 16% upside. But in a bull case, where the anti-dumping duty fully kicks in, defense ramps up, and that KATO JV hits full steam, we see a target of $1,400. That's a massive 54% upside. Even the bear case requires significant deterioration to hit $700. So the asymmetric risk-reward here heavily favors the upside. This cyclical trough literally offers an incredibly compelling entry point for a forensically clean, founder-aligned business. Ultimately, the market has priced ACE for a permanent winter. But with these massive tailwinds on the horizon, a major springtime rally might just be beginning. Are you ready to take advantage of the discount? Before we wrap up, a quick but important disclaimer. The analysis shared in this explainer is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below, and it might be the subject of my next explainer. Thank you for watching, and keep your investing stress-free investing.